What if I told you there's a company trading at pennies, a company that most of Wall Street hasn't even noticed yet, that just posted a revenue increase of 1,362% year over year? Not a rounding error, not a projection. Actual, filed, audited numbers. And what if that same company is quietly building the central infrastructure for the entire Web 3.0 data economy, with 78% gross margins and nearly $116 million in working capital sitting on its books? You're watching Smart Stock Sam, where we dig into the data that the mainstream crowd consistently misses. And today, we're doing a full post-earnings valuation breakdown of DataVault AI, ticker DVLT. We're going to answer the one question retail investors keep getting wrong. Is the market pricing this company correctly, or is it leaving an enormous amount of value on the table? We're going to walk through the technology, the financials, the 72-hour roller coaster that just played out in the market, and, most importantly, what the data is actually telling us right now. Let's get into it. To understand why this revenue number is so explosive, you first have to understand the problem DataVault is solving. Right now, the global economy is sitting on a mountain of completely dormant data. Think about every hospital, every professional sports league, every government agency. They are drowning in massive data sets that are fragmented, unsecured, and essentially worthless because there is no compliant, standardized way to value them, trade them, or even verify them. That data is locked in silos, generating zero return. DataVault's answer to this is a foundational pipeline. They take that orphaned, siloed data and convert it into monetizable, institutional-grade digital tokens. They aren't just storing data. They are minting digital currency backed by real-world information assets. And here's the question almost nobody is asking. What happens to that pipeline's value when the rest of the market finally catches up to what this technology can do? Because the market they are tapping into is almost impossible to overstate. DataVault isn't a crypto company, and it isn't a simple software play. It sits at the precise intersection of three of the largest liquidity megatrends in the modern economy. You've got the Web 3.0 blockchain infrastructure space, projected to reach $350 billion by 2035. You've got the global equity markets, a $126 trillion ecosystem. And then you have the biggest opportunity of all, real-world asset tokenization, which analysts anticipate will exceed $30 trillion. DataVault is not chasing one of these trends. It is building the central switchboard that allows capital to flow between all three simultaneously. That positioning is not an accident, and it didn't happen overnight. The reason they can hold that position without a competitor tearing it away comes down to one word: patents. DataVault is not a Me Too software startup that can be replicated in a weekend. They are protected by a fortified portfolio of 46 issued United States patents, with another 51 currently pending. They effectively own the core legal architecture for how data is valued and secured inside a Web 3.0 environment. This is the primary reason they can sustain those elite 78% gross margins, because no competitor can legally copy the engine. And that engine has a name. It's called the Sumerian crypto anchor, and it is the secret sauce behind everything. Most blockchain-based solutions require you to either move your data or fundamentally alter it in order to secure it. DataVault flips that on its head entirely. Their sonic anchoring mechanism secures a physical asset or dataset directly to an immutable blockchain ledger without ever touching, altering, or moving the original file. The result is total metadata integrity, and that is the absolute prerequisite for any bank, any institution, any regulated entity to ever trust a tokenized asset. Without that guarantee, the entire tokenization movement stalls. DataVault holds the key that unlocks it. Now here's where the business model becomes genuinely elegant. Management has a philosophy they call the Excalibur principle, and it's the reason this company can scale without ballooning its cost structure. Instead of building a vertical application for every single industry, DataVault simply licenses the engine. They provide the core technology, and industry leaders, like their partners at NYIAX, take that tech and use it to dominate their specific verticals. DataVault collects royalties and licensing fees without carrying the overhead of a traditional sales force. It's an effortless scaling model, and it's exactly why gross margins are where they are. But to reach institutional scale globally, you need more than clever licensing. You need the right neighbors. This is the part that consistently surprises people when they first dig into the DVLT story. DataVault has been elevated to platinum partner status with IBM, leveraging Watson AI for their core processing workflows. They've integrated with Clear for biometric identity verification, ensuring they remain fully compliant across regulated industries. And most critically, through their NYIAX acquisition, they now have direct access to the Nasdaq financial framework, the same clearing and settlement infrastructure used by the world's largest stock exchanges. Let that sink in for a second. A micro-cap company has plugged itself into Nasdaq-grade plumbing. The question now is, how does that plumbing generate cash? The answer is a three-step flywheel: capture, process, and monetize. Inbound data from live events, trade shows, or sports venues gets captured, anchored using the Sumerian technology, and then cleared and settled through the Nasdaq framework. They are already establishing active nodes in Seoul, Tokyo, and London. They aren't talking about going global. They are already in the process of building a physical web of data monetization that spans multiple continents. And when you look at what that flywheel produced in the fourth quarter of 2025, the results are almost hard to believe. In the third quarter of 2025, DataVault generated $2.9 million in revenue. In the fourth quarter, 90 days later, that number skyrocketed to $33.8 million. That is a 1,065% sequential jump in a single quarter. When analysts talk about hypergrowth, this is the chart they are dreaming about. But raw revenue is only half the story. What you keep matters just as much as what you earn. In 2024, DataVault was a debt-burdened company operating at 14% gross margins. Today, that picture has been completely transformed. The shift to high-margin patent licensing has driven gross margins to 78%. This was the inflection point that allowed DataVault to report its first-ever net profit, over $600,000 in the fourth quarter, along with an adjusted EBITDA of over $8 million. The pre-profit startup label is officially retired, but here's where the balance sheet tells a story that almost no one in retail is paying attention to. DataVault holds $129 million in total liquid assets, and 92.2 million of that is held in unrestricted Bitcoin. This isn't a speculative position. This is a liquidity waterfall, a buffer that makes the company completely independent of the capital markets for the foreseeable future. And management has issued a definitive public guarantee on the back of it. 0 capital raises for at least the next 12 months. No dilution, no secondary offerings, no surprises from the equity desk. With that safety net locked in, they are now pointing the entire organization toward 3 major launches in 2026. First, an international NIL exchange built in partnership with Sports Illustrated, designed to tokenize athlete name, image, and likeness value at a professional scale. Second, an elements exchange for the trading and settlement of precious metals. And third, a fully FEC-compliant American political exchange built to track and tokenize political contributions transparently. Each one of these represents a new independent revenue stream that addresses the customer concentration risk head-on. The CEO has framed the ambition bluntly. The goal is to become the Amazon of data exchanges. And when Nathaniel Bradley gets asked about the long-term vision, he reaches for a comparison that the market hasn't fully priced in yet. Nvidia came from video, DataVault AI comes from audio. The aspiration is to become the indispensable Salesforce of data, the company that organizes and monetizes the world's unstructured information at a global scale. So if the fundamentals are this compelling, why did this stock just go through a 72-hour nightmare? That's exactly the question we need to answer, because what happened this week is actually the most important part of the entire thesis. Welcome to part 2. If you've had the DVLT ticker on your screen this week, You've watched one of the most volatile 72-hour windows in this stock's recent history. And it wasn't random noise. It was a forensic collision between record-breaking growth metrics and some very serious structural disclosures. And the way the market processed that collision tells us a tremendous amount about where this stock is actually going. It played out in 3 distinct acts. On Wednesday morning, the stock hit a session high of 99 cents on volume that came in between 150 million and 172 million shares. This was high-conviction buying. Investors who had done their homework and knew what the revenue numbers were going to look like. The sentiment was aggressive, and the momentum was building. Then, at 5:30 p.m., the 10K annual filing hit, and the mood shifted in under 60 seconds. The stock suffered an immediate 30% collapse down to 66 cents. 2 disclosures triggered that panic. The first, a $377 million accumulated deficit. The second, a formal going concern warning from the auditors. And if that wasn't enough, the filing also showed that 77% of DataVault's revenue was sourced from just 2 related parties. For a retail trader reading those headlines cold, this looked like the kind of filing that ends a thesis in a single evening. But here's what the institutional grade reader saw when they sat down and actually ran the numbers. And this is exactly the kind of analysis that separates disciplined investors from the crowd. Within 1 hour of that drop, the stock bounced back to nearly 80 cents. Because once the market fully digested the numbers, they realized that the 78% gross margins were the real headline. They looked at $92 million in unrestricted Bitcoin on the balance sheet and understood immediately that this wasn't a company approaching insolvency. The going concern language was a legal formality triggered by the deficit figure, not a signal of operational distress. The company has enough liquidity to fund operations for over a year without touching the capital markets. The market had overcorrected, and the smart money moved in fast. But there was one more shakeout still coming. When the earnings call opened Thursday morning at 8:30, the stock dropped again, this time to 69 cents. The reason was what you could call the dilution reality. During the call, investors came to grips with the fact that in order to fund this transformation, the total share count had expanded from 52 million to 573 million over the course of a single year. That is a 10 times expansion of the float. The market needed to reprice the stock to account for that reality, and it did, quickly and brutally. By midday Thursday, though, the stock had fought its way back to 78 cents. The catalyst for that stabilization was management's ironclad, on-record promise that the Bitcoin buffer means 0 capital raises for the next 12 months. They effectively told the market the dilution chapter is over, and the market believed them because the math supports it. When you lay out the full picture, you are looking at a genuine balance of forces. On the risk side, a significant accumulated deficit, a customer concentration issue, and a float that expanded dramatically in a very short window. On the defense side, $92 million in liquid Bitcoin, a 0 dilution guarantee, 78% gross margins, and a patent portfolio that competitors simply cannot replicate legally. The volatility we watched this week isn't a rejection of the DataVault business model. It's the market doing the math in real time as the company crosses from one identity to another. And that transition is the core of everything. DataVault is actively crossing a bridge from its past, a micro-cap audio technology startup, to its future as a global data infrastructure provider. That kind of corporate re-rating is always messy. The institutional buyers need time to build positions. The retail crowd needs time to understand the business, and the price action has to absorb all of that friction simultaneously. But underneath the noise, the patent-backed technology stack is providing something very important, an intrinsic fundamental value floor. Even with the dilution concerns overhanging the stock, the market continues to support a baseline above 77 cents, because the engine itself is simply too strategically valuable to discount to 0. And that engine is about to operate at a completely different level of scale, When you combine the NYIAX acquisition with the depth of the IBM Platinum partnership, you now have the institutional infrastructure required to realistically target $200 million in annual revenue for 2026. This isn't speculative. The clearing and settlement architecture is already installed. The nodes are already live. The question isn't whether the capacity exists. The question is how quickly the revenue flows through the pipes. There is, however, one critical milestone they must hit first. To maintain their Nasdaq listing, DataVault must reclaim a minimum bid price of $1 before August 24th. From a technical standpoint, they are currently facing resistance at the 200-day moving average sitting at $1.02, while finding consistent support at the 50-day moving average of 77 cents. Breaking through that $1 mark isn't just a compliance requirement, it's the technical gateway that opens the door to a completely new category of institutional investor. Clear that hurdle, and the customer concentration risk that the 10K flagged starts to solve itself. Because the International NIL Exchange and the American Political Exchange, both targeting launches in the second half of 2026, will finally diversify the revenue base across multiple independent streams. Management is targeting a 400% increase in total revenue for next year. Whether they hit it precisely or not, the architecture to support that level of growth has been built. Before we get to the final verdict, a word you always deserve to hear on this channel. Everything discussed in this video is for informational and entertainment purposes only. It is not financial advice, and it should never be treated as a recommendation to buy, sell, or hold any security. Investing involves real risk, including the possibility of losing your entire principal. Always do your own due diligence and consult a licensed financial advisor before making any investment decisions. So, where does all of this leave us? DataVault AI has survived the friction of its own transition. They have reported their first net profit. They have established a Bitcoin-backed liquidity floor that removes the immediate dilution threat. They have the Nasdaq plumbing, the IBM partnership, and a patent fortress that no competitor can legally walk through. The 72-hour tug-of-war we just witnessed wasn't the story ending. It was the story beginning. The pre-dilution analyst targets sitting at $4 per share were established before this 10K volatility even hit. The architecture for the global Web 3.0 economy is online. The exchanges are being built, and the flywheel is already spinning. The real question the data is asking you is this: is the market missing it, or are you? Lastly, I have intentionally missed an important part on short interest and squeeze setup, because right now it's more important to understand the fundamentals before moving on to market mechanics. Short squeeze setup is there, and I will be covering it in my future update. Now, if this breakdown gave you a new angle on the story, drop your take in the comments. I want to know what you're seeing. Hit the like button if this research was worth your time, and subscribe to Smart Stock Sam so you never miss the setups that the crowd walks right past. Check the hype leaderboard and see if your comment makes the cut. I'll see you in the next one.